Hello and welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook, and I'll be your host for about the next, which kind of makes sense. We're having some more geopolitical concerns across the globe, and it's driving the markets a little bit lower. But more important, well, I wouldn't say more importantly, but what it has done to the bond market is drive the bond yields quite a bit higher. The threat of recession has kind of subsided a little bit. When I look at the CME Fed Watch tool, as far as interest rates and increasing them a quarter a point on the November 1st Fed meeting, we're talking about a 14% chance. Now, I've really seen that probability based off of the futures. That's the CME, which is where the futures market trades, and the Fed Watch tool. That has been extremely volatile. So if I take a quick little peek over here on my screen, we see that a week ago, it was trading right around 27% probability. A month ago, it was trading around a 43% probability. So the probabilities of the Fed's, let's just put it this way, the marketplace doesn't seem to know. That's extremely volatile, more volatile than it was previously about that probability of them raising another quarter point in the November Fed meeting. Now, one of the things that I also find interesting, if you take that CME calculator and you go out a little bit further in time, the first time you see a chance of them lowering interest rates, in other words, reducing, going down a quarter a point, is going out to the, 1 second, let me grab this here. The January 24 Fed funds meeting is the first time we actually see a probability of the probability of the Fed funds actually being reduced and lowered. And then if you go out to March, that's looking right now at they're putting about a 6% chance on it. So very low probability. And then if we go out to March, in March, we're seeing right now about a 25% probability that the Fed will lower interest rates. So interesting to see that. I think the whole dynamic of the marketplace has changed. I think the 10-year is showing that. But now we have another issue that is actually we're all worried about spending. We have on November 11th is going to be another drop dead date as far as the budget is concerned. Everybody's kind of stopped talking about that just for a second. And we don't have a Speaker of the House yet. So there's a lot of just landmines that are sitting out there. We're still in October. We had a bad September. Once again, September proved to be one of the worst calendar months of the year. So hard for me to get bullish on anything. And you can find bits and pieces. We've done a few paper trades that have kind of worked out on the bull side. So we're going to kind of stay the course with some of the strategies that we are looking at. We got short in the QQQs, and we also got short in JETS, which is an ETF that tracks airline stocks. And that chart has kind of been a little bit ugly. So I'm going to pull up the JETS chart right now, and you can see this almost looks like something that belongs on Peloton, right? This is this huge drop down. Looks like a real strong mountain climb if you're doing your little cycle thing on Peloton. But recently, we really dropped off a cliff here. So we put this trade together, and I'm just going to talk about it real quickly because we're coming down to the expiration date on that trade. But we bought the 19 strike put. We bought it, I guess, I don't know the exact date, but it was probably about 15 days ago. And that was trading for 110. It's now trading for 293. Now, why do I bring it up is because the expiration date is on 10/27. We looked at actually selling a short put already once against the position, and there just wasn't a lot of premium that was in that trade. So we talked about actually getting out of the trade. It was a doubler at this time. Now it's a tripler. It's trading for $2.93. We paid $1.10, so a little less than triple on that trade. But so here's the expiration. I'm going to run to the options grid. Let's take a peek at it now. And inside the options grid, we see we bought the 19 strike put. So let's click on that. We're going to click on that ask price. We're going to put that one leg there, and this is where it's at, 286. So it's actually dropped about 5 cents since I looked at the quote before the show began. And we are now trading right around 16 actually. And if I wanted to, with this short time remaining, with the expiration at 10:27, and this is the change that we're looking at here in Jets, 10:27. And if we look at that trade, we see that the 16 strike is trading for 49 cents. So I've came down to a range where I feel comfortable about this trade. And we're going out to the October, it's October 9th right now, and we're going out to October 27th. So this is a range where I wouldn't mind getting some time decay. And it's mainly because, so you're talking about okay, so 27 and 19, we're going to say about a 2-week window where we're going to have a large rate of time decay on an option contract that we've sold. Now, the 19 strike is fairly deep in the money, but if I wanted to stay in that position and try to eke out a little bit more capital on the trade, I would think about selling this 16 strike put. If I look at the chart, let's go back to it right around here, and I can zoom out a little bit more. Let me add a few days here. We're going to go, that's fine. That's a good number. Right around this 16 level, we do start to see a little bit of support in this range. Now, obviously, the bottom of the marketplace in the near term, 522 days back, is down around this 15 level. But we do see a little bit of support. Now, the chart is ugly. We had a couple of death crosses here. As far as the moving average is concerned, we had the 20-day cross over the 50-day, and then we had the 50-day cross over the 200-day. So the market doesn't really look very solid. But if I wanted to sell something right down here around that 16 level, right where there's just a little bit of support, came down and touched right here, a lot of activity right in this range. This is where I would probably sell that put option. 14 days, you got a huge rate of time decay on the one that we've sold. And once again, this isn't meant to be a recommendation. This is just, we're looking at option pricing, and this is what we do here on Options Guide TV and using the options playbook, and think about, how could I adjust this trade? If I don't want to get out of this trade, how would I adjust it, and what would I look to do? How could I bring some capital out of the trade and still give myself some upside in the near term? So because of where the market's trading, because we're getting down to around 14 days left before the expiration day, a couple of weeks out, that's really where we see huge time decay. Why don't we sell something against that position? I probably would just take the trade off, right? If I've already tripled it, and consider that if we actually did break down below this level, then we're really kind of scared in that marketplace. But right here, I'm either going to take it off or I'm going to do something to get it against it. So let's talk about the do something. Here's the 16 strike put. It's trading for 49 cents by 46 cents. Wouldn't mind doing the 15. I'd love to give myself a little bit of upside, but it's not enough money. So I'm just not going to do it. It's that simple. So I'm going to sell this option contract against it right at that 16 strike. And I think that's kind of where our support level is at here on this trade. And I'm going to bring in 59 cents. So when we put on the trade, we paid $1.10 plus commission. So that's $110 for one contract. We're now going to sell this option contract, and we're going to create this long put spread. We'd be long the 19 strike and short the 16 strike. We could bring in $3 from doing that, and above and beyond that, we can bring in 50 cents from this trade. So here's the leg in trade: is we remove this contract and we sell to open this 16 strike put. for 47 cents and add that to our position. Just a way to look at it, something you might want to think about doing. I would really like to sell the 15 if we could. I just wish there was a little bit more premium that was in that option contract. All right, so rinse and repeat. We looked at an iron condor in the SPYs. In our last iron condor that we looked at, we had a November 3rd expiration. So that thing is still living. We sold the call put spread on the upside to start, brought in 53 cents or 52 cents when we did that. And then we, after the markets moved a little bit, we sold a put spread and brought in another 53 cents. And that's $1.05. But as I mentioned at the top of the show, markets can't really decide what they want to do right now. And until that November 11th date, until the government until Congress gets together and decides if they are going to kick the can down the road again, if they're going to come up with an actual budget for the next year. Until we get that resolved, and there's a lot in there. There's the funding for Ukraine, funding for what's going on in Israel right now. So there's going to be a lot of discussion. Congress hopefully is going to be in session a lot over the rest of October and try to get some of these things resolved. So one thing that I don't want to do is I don't want to go out past that date. I want to be not even close to that date, actually. And we're going to look at another iron condor. So we're going to start by doing the iron condor outright. Last time around, we legged into it. We sold the call short spread, and we sold the call short, or the put short spread, and we combined and we legged into an iron condor. Now, for the first time, since there's nothing I really want to get long in the marketplace, let's just look at doing an iron condor, and we're going to do a shorter term one. The trade that we set up a few weeks back was, I would say, a more standard iron condor, something that you might do month in and month out if you are neutral on the marketplace. This one is going to be a little bit more speculative. We're going to go very short term, and we're going to see how much premium we can bring in on a 2-week SPY trade. So when we started before, we looked at beyond 30 days, which is that's kind of a sweet spot, I think, for if I'm looking for time decay and I don't plan on being in it forever. Anywhere from 30 to 40 days, I think, is kind of a nice range. And I usually want to get out when we get down to the 15-day mark, or when we approach this area where if the market goes against you, it can hurt you. And so, as always on Options Guide TV, I like to look at different scenarios. So let's go in and look at what a couple weeks out iron condor would look like in the SPY. And so if that is the case, right now we have we need to look at 7 days. There's so many expirations. So October 17th is 18 days out, and we're gonna go a little bit further than that. Just have too many expiration days. October 27th is 18 days. Let's do right on 14 days. This is the very volatile period as far as time decay is concerned, and fairly expensive options in something like the SPY. And before I do that, I just want to make sure that you know that if you are on YouTube, you can actually put something in the chat box and you can ask about the previous questions, anything you got on the Jets trade, paper trade that we looked at. And also, if you want, we're exploring what we can do in the SPY, please feel free to put that in the chat box and I'll try to address it at the end of the show. We want to make this as interactive as possible here on Options Guide TV. All right. October 23rd. Okay, here we go. So if I look at the Trade Hawk options grid, there's a lot of great features that I love about this. First of all is the 1 standard deviation move that we highlight. We have 14 days remaining, 428. This is the most at the money option contract. We look over here, we see that, yep, this is the 10/23 expiration. If we scroll down, I have my grid set up so that it'll show you right around a 1 standard deviation move, which the delta should be right around 16 if we're looking at a 1 standard deviation move. And that's on the put side. And then we're going to go up to the call side. We're going to also look at that same situation. Should be right around 16. It's all the way down here. It's somewhere in this range. I think we're going to focus on about the 440 level. So let's start by setting up the put side first. We're going to go about 1 standard deviation move out of the money. 413 is trading for 130. So we're going to go 5 points just like we did on the first one. We want to compare apples to apples. And we got 19 delta here. I guess we'll sell. We don't have as many strikes. So let's sell the 415 on the put side and buy the 410. And that's because we don't have any strikes between the 410 and the 405, but I want to stay 5 points wide. So I'm going to sell this one. So I'm going to click on that bid, and then we're going to buy the 410. So we're 5 points wide. That's our short put spread. That means that we're neutral to bullish on the trade. And I'm okay with just selling this. This is 5 points wide. You're bringing in a 60-cent net credit to the account. Means you have $4.40 worth of risk on this trade. And we're all the way down to 415. We have the SPY trading at 427. It's down about 1/3%. So that gives us a little bit of leeway from where the market is at, the probability of it finishing at least 1 cent out of the money on the expiration date. If we look at the delta, is right around 20%. So we're going to go up to the call side. We're going to hang right around in that range. I think I'm going to do 435 and 440. Okay, so we're trading right around a 15 delta on. Oh, there's the delta. Maybe that's what I did wrong over here. No, 19 delta is right. Okay, so over here we're looking at about a delta right around. My delta's changing on me as we speak. I'm going to sell this I want to sell 440 and a 445. So we'll do this one. 30% chance. I want to get further on the money. All right. I don't know why I don't have the strikes that I want. Because it's not. All right. So in this instance, gosh, I'm a little befuddled why I don't have a 455 strike on this October expiration. So, I guess we'll do the 440s and buy the 450s, and we'll do 10 points wide on the other end then, and that'll make it simple. So we're gonna we should be bringing in close to $1, $2 on this trade. We're gonna take on a little bit more risk, but let's do it. Here we go. Okay, so we're going to sell the 440s on the bid. We're going to buy the 450s on the ask. We're going to bring in about $1. Now, how did I know that it was going to be about $1? Because we were bringing in about 50 cents on a 5 point wide trade. So if we double it, it should, if the pricing, which is always very solid in the SPY, is going to basically double the credit. We're doubling the risk. We're going to double the credit. Instead of having 5 point wide spread in risk, we're going to have now a 10 point wide spread. A little bit wider than I want to be, but I'm going to still do this. We're going to ride with it. All right. So 405, 410. Down here, we're at, then there's no 415. Okay. So now here, we're going to look to do the 415 to the 410. All right. Now I don't see the numbers that I want on this end. This delta is at 28. All right, we'll sell the 410. Yeah, I'm okay with that. We're going to sell the 410 and buy the 400. Okay, so let's click on this bid, and we'll sell that 410. And then we'll go down and we'll buy the 400. All right, need the market to move on me. because now in this instance, we're further out of the money. We're still 10 points wide. Okay, gotta delete this. And we're bringing in $1.59, but on here we got a 12 delta. So there's about a 12% chance of that underlying finishing 1 cent in the money below the 410 level. So now we got a much wider trade, but here's the benefit of this is since we're doing the iron condor, our risk is only on one side of the trade. The marketplace can't be up and down at the same time. So either you got the risk from the being short the put spread, or you have the risk from being short the call spread. So we have a 10-point wide trade, and as far as your margin requirement is concerned, all you have to do on that, as far as your margin requirement is concerned, we're only going to hold out one side of the trade. So if you take 10 minus, right now, let's call it $1.60. Let's make the math simple. We have then $8.40 worth of risk on that trade. We are further out of the money on the put side, and that's actually where I would rather be on the put side, rather be a little bit further out of the money than on the call side. I think the path of least resistance is more so to the downside. Not happy about where the strikes worked out on this expiration, but I'm still bringing in $1.60. I have a high probability of success. And let's put this in the what if calculator. And we'll see here that, okay, here's where the underlying market is at, 42.28. Right up here is where our risk kicks in at the expiration date. And that expiration date is going to be the 23rd of October. So from here on down, we have 10 points worth of risk minus the 160 or $8.40 worth of risk. On the way up, if the market keeps going on up, and on the way down from this point down from 410 all the way down to 400, that's where our risk is on the downside. Our sweet spot is going to be between our upper strike, the 440 call, and our lower strike, which is the 410 call. So we got a 30-point area that this underlying can land in and make the maximum profitability on the trade. Okay. So if I look at this and I'm considering what's my out strategy, I'm able to bring in $1.60 on the trade. If I can get usually half of that premium, I'll consider taking that off. So I sold it for 160. If I can take it off for 80 cents, I'm okay with that. Now, in this trade, I'd probably look to try to get at least another 40 cents on the trade. We're going on a short term. We have a large rate of decay. So my goal on the downside is to buy this iron condor back for a net debit of around 40 cents. That also means on the upside, I got to be, since we went a little wider on this trade, which I don't have any problem taking on that risk. We usually don't talk about something that has this type of risk reward, but the strike price has kind of forced us to a little bit. But if it's on the upside and it's going against me, I don't want to lose more than 80 cents. So I put it on for 80 cents. If I see it trading for 160, I want to take that risk off, especially because I have a 10-point wide spread in this scenario. So I brought in $1.60 on this trade. If I see it trade for about 80 cents higher, I'm going to start reacting to the trade. So let's make it $1. Let's say our out point on the upside is going to be $1. Make the math simple. So we put it on for $1.60. If we see it start trading for about $2.60, we're going to either adjust the trade on one side of it, and that's a possibility, or we're going to close out the trade and get out. That simple. All right. So if you have any questions or comments, please let us know in that chat box. And if not, we're going to come back on Wednesday and we're going to look at this trade. This is going to be a very interesting paper trade to follow. And we're going to look at any adjustments that we might make. We have our plan. We know when we want to look to adjust or close out that trade. And we'll see how the Jets trade's doing too. Obviously, a lot of news happening this week with what we had happen overseas over the weekend. And best of luck on that, right? As far as interest rates are climbing, less probability of the Fed raising 1/4 point, budget talks. But besides that, there's nothing. All right, that's it for this edition of Options Guide TV. Please click subscribe, ring that bell, and pound that thumbs up. And we'll see you this coming up Wednesday for the next edition of Options Guide TV. Thanks for coming, everyone.